Those smart investors don't chase what's already expensive. They look for the thing that's sitting quietly on the clearance rack, the thing nobody wants yet. And today, I firmly believe that thing on the clearance rack that people are ignoring is real estate, particularly apartments. Welcome, everybody. This is Buck Joffrey with the Wealth Formula Podcast. Hope you had a nice holiday week, festivities and all that. Before we begin, I do want to remind you that there's a website associated with this podcast, and it's called wealthformula.com. Why do I bring that up every time? Because that's where you go if you really want to get involved with this community. Specifically, if you are an accredited investor, you should go to wealthformula.com simply to sign up for the free accredited investor club, because that's where you're going to see potential deal flow. You don't have to pay anything. All you're doing is giving yourself permission to see potential deal flow that you may be interested in that is only available to accredited investor. Now, what is an accredited investor? An accredited investor is not something you apply for. You either are one or you're not, sort of like pregnancy. It just simply means you make at least $200,000 per year with a reasonable expectation of continuing to do so in the future. You've done so in the last 2 years. That's $300,000 if you file jointly or you have a net worth of $1 million outside of your personal residence. If you meet those criteria, which you probably do, you are an accredited investor, and all you need to do is go to wealthformula.com, sign up for Investor Club, get onboarded, and hey, it's another source of education. Because the way we do this stuff, it's not just throwing out deals. What we're doing is we're having educational webinars where people can learn. And if you want to invest, then great, but you don't have to. Nobody ever has to do anything. It's just a way to see deal flow and continue to build your financial sophistication. Okay. Now, one of the things that we do a lot of in Investor Club is apartment buildings. It's my favorite asset class. I mean, it is something you need. People need to live somewhere. I mean, fundamentally, that is that's the kind of thing that, generally speaking, drives me towards the space. And frankly, this has been a family thing. My father was is an apartment guy, and residential real estate has just made sense to me my entire life. But anyway, getting back to the holidays, it is that time of the year again, Black Friday, Cyber Monday. Everyone loves a deal, right? And if you've been investing long enough, I will say this, one important fact, there's always something on sale. The problem is that the herd never sees it, right? Otherwise, it wouldn't be on sale. They're too busy chasing whatever feels safe. And what feels safe is the things that's setting new record highs, right? And right now, that's the stock market, that's gold. Everyone's piling into the most expensive things that they can find and patting themselves on the back for being prudent. Okay, but smart investors, the ones that over time you say, well, gosh, how'd he make that call? Or, how did he figure that one out? He made a killing. Those smart investors don't chase what's already expensive. They look for the thing that's sitting quietly on the clearance rack, the thing nobody wants yet. And today, I firmly believe that thing on the clearance rack that people are ignoring is real estate, particularly apartments. We've seen this movie before, okay? Things that are on sale, people don't pay attention. Like, okay, let's go back to the early 2000s. After the dot-com crash, everybody ran to gold and treasuries. Meanwhile, the very companies that would define the next 2 decades, Amazon, Apple, Microsoft, they were sitting there marked down 75, 80, 85%. And you didn't need to be a genius to buy them. You just needed a stomach. If you understood that this was something that was going to continue, like something like Apple was going to continue to be around for a long time. And then there was 2009 through 2011, and this is probably more relevant to many of you. This was sort of my, first real time with money where I saw something like this happen, which was that real estate was radioactive. The media made it sound like apartment buildings were going to fall into sinkholes. But guess what? If you bought during that window, the values didn't take 10 years to recover. They snapped back within 3, and they kept running for another decade. Okay, so again, you don't have, I mean, it's not just stocks. It's not just real estate. 2020, oil going negative. I mean, that's the kind of insanity that only happens once in a generation. And people were literally joking that Exxon would pay you to take barrels off their hands. It was absurd. And it was the greatest energy buying opportunity in modern history. But most people sat on the sidelines in fear, not looking at the big picture and saying, I think probably we're going to need oil. We're going to probably need oil after this pandemic's over, after, the dust clears. The point I'm trying to make is different cycles, different assets, same principle. If you want outsized returns, you've got to be willing to buy what everyone else is mispricing. And right now, the only major asset that's not making all-time highs is real estate. In fact, I mentioned our Credit Investor Club. I mean, we're finding deals, right? We're still finding deals that are discounted 30 to 40% from just a few years ago. I mean, it's enormous, the kinds of discounts that are available, in the right hands to sit on for the next couple of years as prices completely change. And I've talked about that before. Apartments specifically are in this bizarre sweet spot where pricing is still beaten up from the rate shock, yet the fundamentals underneath are strengthening. So what's happening? Sellers who bought with floating debt are fatigued. And a lot of us know that because a lot of us actually were hurt by this, right? And listen, you have to be able to take a little bit of the downside to focus in on and take advantage of the upside, because buyers with real dry powder are now getting real discounts. And guess what? Construction has collapsed too, meaning supply will be razor thin in about 18 to 24 months. That's what is being projected. And the interest rate environment, we've talked about this before, and I'll mention it again. It's the direction apartments benefit from, right? Rates are going down right now. The December rate cut is kind of a no-brainer. I mean, people thought it was a 50-50 chance last week, and this week, basically 85, 90% chance that the December rate cut is going to happen, another 25 basis points. And rates matter. This is why rates matter. It's why liquidity matters. This is why cycles matter. When financing costs come down and supply is constrained, like I just described, prices don't grind higher, they launch. And just think about the way people are behaving right now, right? When it comes to real estate, this is exactly what the bottom feels like. Bottoms never feel like bottoms, right? If people knew that they felt like what a bottom felt like, they'd just be like, oh, okay, I better buy now. They feel confusing. They feel uneasy. They feel contradictory. And that is precisely why it's the opportunity. Every big wealth building moment looks like this in real time. You see what's happening? Everyone's distracted by what's hot while the discount sits right there, plain sight. Make no mistake, if the Fed keeps cutting and liquidity continues loosening, apartments aren't going to stay discounted, though. They are going to do what they did after 2009. They'll do what, oil did after 2020, and they'll do what tech did after the dot-com crash. They'll reprice fast, and before you know it, you're going to go from a highly discounted market to a frothy market. And that could just take 2 or 3 years, right? So you want to be in a position, in my opinion, that when that time comes, you've got something to sell. Years from now, people will look back at this moment and say the thing they always say after missing these obvious type scenarios. It was right there. Why didn't I buy more? Well, it is right here. Apartments are on sale, and this is your opportunity if you want to do it. Now, no one has been beating the drum more on this than my guest this week on Wealth Formula Podcast, Zach Happenstall, and we will talk to him right after these messages.
Wealth Formula Banking is an ingenious concept powered by whole life insurance. But instead of acting just as a safety net, The strategy supercharges your investments. First, you create a personal financial reservoir that grows at a compounding interest rate, much higher than any bank savings account. As your money accumulates, you borrow from your own bank to invest in other cash-flowing investments. Here's the key. Even though you've borrowed money at a simple interest rate, your insurance company keeps paying you compound interest on that money, even though you've borrowed it. As a result, you make money in two places at the same time. That's why your investments get supercharged. This isn't a new technique. It's a refined strategy used by some of the wealthiest families in history, and it uses century-old, rock-solid insurance companies as its backbone. Turbocharge your investments. Visit wealthformulabanking.com. Again, that's wealthformulabanking.com.
Welcome back to the show, everyone. Today, my guest on Wealth Formula Podcast, well, he's a repeat guy. He's a friend of the show and of our investor club. His name is Zach Havenstall. He is CEO and co-founder of a company called Rise 48, which is one of the largest, most successful and fast-growing real estate companies in the country. Zach, how you doing, buddy?
Hey, what's up, Buck? Glad to be here. Thanks for having me. Doing well. Just we're wrapping up some year-end acquisitions, trying to take advantage of the new depreciation. So it's good. We're finishing strong.
Yeah. Hey, I was thinking about you last week. I don't know if you you probably don't have time to listen to my show, but last week, or actually this will be next week for you because when we're recording. But yeah. I recorded a show with a guy on sports economics, and it was all about what drives values in professional football teams. And we talked a ton about all sorts of stuff. And I was thinking about you because I understand that you spent some time in the sports space yourself, didn't you?
Yeah. So I played college football. Then I went and I got a journalism degree. So I was actually a sports reporter on Arizona PBS and a news anchor. And
that's so cool. That's so cool, man. Where did you play college football?
It was just some small Division II school in Colorado called Colorado Mesa University. So I wasn't good enough or big enough to go to the NFL, Buck, and that's why I wanted to go be a sports reporter. And so I did that for a little bit. And then I realized that you don't make as much money as you thought. I wanted to make money. So I went into real estate after that. So
yeah, I mean, I guess a few of those guys probably, they do pretty well. You know what I mean? But that's more rare than an actual professional athlete because there's far less of them.
Yeah, you're right. It's a small sector. And it's funny, I went to the top journalism school in the country. And I graduated top of the class. So I could have gone that route. It's funny, just this morning, no BS. This morning I saw an article. This guy I went to school with, his name's Bill Malugin. He was in my class and he just became the chief congressional correspondent for Fox News. He's a rising star. I also went to class with the guy who's the top guy at MSNBC now. So it's kind of funny seeing the people I went to school with in journalism.
Well, a guy like you's probably been successful in anything, but fortunately for us, you chose real estate. So
yeah, I'm grateful.
Yeah. So, just as a reminder, why don't you just kind of tell us a little bit about your company just before so we can set the stage, and then we'll kind of talk about what's going on in real estate.
Yeah. Thanks, Buck. Yeah. So Rise 48 Equity, we're an owner-operator of multifamily apartment buildings. And so we have purchased 62 assets, about 12,000 units, over $2.5 billion of real estate. So we're basically buying existing apartment buildings, going in there and improving operations, renovating them to increase the value, to get that profit margin for our investors. So we are an investment company at our core, but we're also vertically integrated, meaning that we have our own property management company, our own construction company, so that we have full control. So we are in Phoenix, Dallas, and North Carolina. We have about 350 full-time W-2 employees. We've sold several properties. We've sold over 1,000 units, but we currently own and manage a little over 10,000 units. And so that's kind of this is all we do, is just focus on buying good real estate investment opportunities to serve our investors is what we do.
You have a pretty impressive track record in terms of dispositions. Just a little review on that performance, if you.
Yeah, so we have effectively purchased, executed the plan. I mean, we renovated the properties to what we had planned to do, and sold 11 different apartment buildings, which is over 1,000 units, over $200 million worth of real estate. And we've more than doubled investor money on average across those deals. And so that's something we're really proud of. And we think, I mean, honestly, Buck, I mean, I'm sure we'll get into it, but we think right now is really the bottom of the market for everything that's going on. So we're excited to buy some good opportunities right now.
Yeah, and part of why you're able to do that is, I mean, it's not like it wasn't hard for you guys. It was hard for everybody the last few years. Yeah. But you managed to get through it, and I mean that get through it and really not, lose any capital. You never missed a debt payment, all that. And that actually is a big deal because, as you mentioned, there has to be, buyers out there, and you guys are one of the most active buyers out there, and it's helping you to get to these situations where, every deal that I see from you guys is like a 30%, 40% distressed asset discount that you're basically able to do because you're getting them off market. You're finding the sellers who are, need to get out quickly, and they know you can close. So that has been like the ironic nature of sort of a really down market is the strong operators come out even stronger. Do you think that's fair?
Yeah, you're exactly right, Buck. I mean, there's no denying the last 3 to 4 years have been an absolute grind. As interest rates shot up, all this new supply, it's honestly been like survival of the fittest. In the space, and there's been a ton of groups that they're just done. Like they've been foreclosed on. I just found out yesterday a property that we sold in the first half of 22, when we more than doubled the investor money. It was a big, well-known private equity firm. They just got foreclosed on that asset. We sold them a month ago, and so it's very common, unfortunately, for the industry. It's happening, but we've been able to weather that storm mostly just because of our operational expertise and ability to renovate these units and get through it. To your point, never missed a monthly debt payment on any asset, never lost investor capital. We've been able to weather that storm. And now what's happened is that because so many groups have faced this adversity and been wiped out, losing properties, losing investor capital, very few groups can actually raise money. Yeah. So like the sellers and the brokers, when there is another distress opportunity, there's such a limited buyer pool that can raise that money. And so, because we've been able to get through that, our investors have really, I think, respected that and trusted that. And now these sellers, when they have to sell a deal because maybe they have a loan maturity coming or their fund is ending, whatever, we've kind of developed that, that track record just in the last 24 months as one of the few groups that can perform. So we're actually seeing a lot of deals right now that most groups are not seeing at all, just because they have to close by a certain timeline, and they can't have any execution issues, and we can execute. So knock on wood, Buck, we're 62 for 62. Every time we've gotten a deal under contract, we've been able to close. And I think that's just become even more rare the last 12 months, for a lot of our industry.
Yeah, for sure. And the other thing, from the lending side, I think you've sort of been able to prove your value to the lenders, which is another big deal. From my understanding, they're actually some of the properties that they've taken in basically is, basically foreclosed on. They're having you guys manage those?
That's correct. Yeah. So we're actually now managing in Dallas. We are managing over 1,000 units, third party, for our lenders who have taken those properties back from other borrowers because they came to us and they said, hey, you guys are doing great on the properties that we have with you. We need some help here from a property management, asset management perspective. So yeah, we're now doing third party for several groups. And then, just a few weeks ago, we actually just bought a deal directly from one of our lenders. They foreclosed on a different borrower last year. And they came to us and we were able to buy that at a huge discount. And so, yeah, I think that is the silver lining is that, the last few years, we've showed a lot of these big institutional lenders our ability to perform, and it's actually strengthened those relationships. And, we're able to get loans on new acquisitions right now that most other groups, these lenders will not finance them. And so that's been, a advantage as well.
In terms of the success, right? I think about like what I know about you guys, and obviously operational ability is number one, right? These properties that I'm involved with, they're all are all kicking ass. Like, there's no issues with vacancy. They're distributing every month, that kind of thing. What else were the keys? Like, in terms of how you guys were able to navigate, the distress in the marketplace?
Yeah, it's a good question. So I think, it starts with having that vertical integration. I think the fact that we own our own property management company and the construction company, that gave us a lot of control. I know a lot of groups using third-party management companies, they've just kind of fallen apart because the incentives are not aligned, and that's given us a lot of flexibility to really quickly change our strategy for certain properties on a month-by-month basis to do what's best to kind of navigate this market cycle. And then it sounds cliche, Buck, but when we have that infrastructure and we have the control, then the next step is, okay, what about like your people and your culture and your standards, right? And I would tell you that the last 3 to 4 years, our company has evolved where when we first started, the market was strong. As a CEO, I was really focused on, like, I wanted to be a people pleaser and I wanted everybody to be happy and a really happy place to work, which we still want. But what we've realized the last few years is that, we need to develop, accountability and a very high standard of expectations. And the people that don't meet that standard, we tell them you're gone. Okay. You can leave. And we want really high performers. And what we found is the more A players and high performers we put on the team, they're just going to work much better together. And I've seen other groups, like I have friends that they have basically turned on their business partners because when times get really tough, you're going through adversity, it's easy to turn on each other and you can point the finger. I think the one thing that I can point to is that internally we've had each other's backs. And even though there's been, we've had our fair share of screaming sessions because it was like, let's get through this. Let's figure this out. But we've stayed united, and we have a core team at our company that has kind of been through the fire. You know what I mean? And we've developed a lot of trust and respect internally for that. And so it sounds cliche, but it's so true, is the culture, the camaraderie, the trust and communication within. I think we've become even stronger because then that permeates throughout your organization to different layers of leadership and management, down to the on-site level. And just earlier this year, Buck, we built out an executive leadership team at our company. So it's myself, my partner Bikron, and then 4 of our top level employees, VP director level staff. We developed core values for the entire company. And we told, I do these quarterly all staff meetings where I talk to everybody in every market. I fly to Phoenix, Dallas, North Carolina, and I go over the core values and I say, these are the people, these are the standards you need to hold people accountable to when you're hiring somebody. If they don't meet these standards, do not hire them. And I've even said, Buck, if you are an existing team member and you don't think that you can improve to meet these standards, then maybe this isn't the place for you. You know what I mean? So we've kind of shifted. We're like, let's make everybody happy to, we want people who want to be here. We want it to be a championship level team. And this we have to do and kind of being more selective. And I think that that's really given us an advantage.
Yeah, it's funny, it is a little cliche, but you go back to the sports analogy, right?
Yeah.
These you can have a few stars on the team, but if they're not gelling together and not working together, you're not going to get a good outcome.
It's so true. In the early years, Buck, real quick on this thought, because I am passionate about this, honestly.
Yeah.
When we were like 100, 150 people, I always thought core values were cliche BS. And I was just like, no, like we just need high performers. But as we get bigger and bigger, I can't touch, all those frontline employees. I don't even know a lot of them in different markets. And it's like, how do we communicate the standards and the messages throughout an organization across the country? And we've had to build out, those standards and that infrastructure so that you have a uniform standard. And so I've realized just in the last 12, 24 months how important that is. And I think we've done a good job finding people that meet that standard.
Yeah. Well, the good thing, there's lots of good things there, but just to say that you're now very strong company with a very stable portfolio. Certainly, at least from my perspective on the things that we've been doing, it's been great. Approaching this real estate market right now, what's going on? How do you view the macro on this real estate market right now? And you're talking to some of the biggest owner operators out there. Like what are people thinking?
Yeah, good question. So there's a couple different dynamics, I think, to focus on when we're talking about, macro economics of real estate right now. Obviously, the first one is interest rates, right? And so, as many people know, I think by the time you've released this episode, the Fed in September of 24 cut rates for the first time in several years. They cut again in December of 24. We all thought 25 was going to be a big interest rate relief year. Then in January of 25, the Fed, Jerome Powell, comes out and says basically everything turns 180. Said, oh, we're not going to really change much this year. There was a lot of tariff rhetoric and concerns of that driving up inflation. And so I think most of the year, it's just kind of been, a lot of uncertainty. Well, then, by the time we get to, late Q3, Q4, it looks like these tariffs actually have not had the impact on inflation that most people thought, right? And so the Fed cuts, they do their first 25 basis point cut in October of 25. They just cut again in November, or I'm sorry, they did the first one in September of 25, then in October of 25. And now it's looking like they're going to cut again, most likely here in December. And, the current Fed chair, Powell, his term will expire in May. So I think President Trump is supposed to announce by the end of this year who that next chair will be. And it's widely expected that we're going to have consistent interest rate cuts going into 2026. And so, as many of your listeners who I know are investors in these types of assets know, as these interest rates come down, the values of these large apartment buildings will go up, right? And so we truly believe at Rise 48 that we are at the bottom of the market right now, where we can still find these opportunities where there's distress, and we're buying them at what we think is the bottom of the market. We don't think the market's going to go any lower than it is now, and that will have tailwinds. So the interest rates are a big factor of why we think now is a good time to buy. But that window is closing. And when I say closing, maybe 6 to 12 months or so, it could be less, where we can still buy these 30% plus discounts, like you said, from peak pricing just a couple years ago. Interest rates is a huge driver of that. The second big variable, Buck, is supply. Okay, so we talk about like the macroeconomics, economics 101 is supply and demand for any business. And so in this case, we're talking about the supply of housing. So what happened was really from like 2019 through 2022, all the Sun Belt markets across the United States started booming. Okay, so I'm talking about Vegas, Arizona, Texas, Florida, Atlanta, the Carolinas, because this started pre-COVID, by the way. People started leaving these other markets and going to these strong Sun Belt markets, but COVID just like poured jet fuel on it. So especially post-COVID, you have all this new in-migration of people leaving other markets, coastal cities, and going to these Sun Belt markets. And then you had all these companies moving there, and there's all these new jobs popping up. And so then there was a huge need for housing. So all these multifamily developers start building apartments like crazy. And, as you know, Buck, it takes, 3 years or so to actually deliver an apartment building, meaning it's now built and ready to be leased up from when it begins being developed. Well, during that 3-year window, a bunch of crazy stuff happened, right? I mean, we saw inflation skyrocket up to nearly 9%, which caused the Fed to start increasing interest rates. They started increasing interest rates in 2022 at the most aggressive rate since the 1980s in over 40 years. And because the inflation was so high, a lot of these people, these tenants, they could not afford their groceries, their gas, whatever. And so you had actual demand of housing went down significantly over that 3-year span. So by the time you hit, 23, 24, and especially 25, all this new supply of housing is flooding the market. So you now have more supply than you have demand. And what that did is it created negative organic rent growth across the Sun Belt, right? You have a lot of concessions where people are offering specials. They're trying to undercut each other, fighting for occupancy. Some of these Class A apartments are giving 3 months free rent. Well, at the same time, what happened was that when the Fed started increasing interest rates in the summer of 2022, what that did is it virtually paused all new development of apartment buildings. So since the second half of 22, there's been little to no new development or starts of apartment buildings because interest rates blew up all those construction loans. And again, it takes a few years to see the residual impact of that. But heading into 2026, when we look at the supply charts for all these major Sun Belt markets, and again, we're focused in Phoenix, Dallas, North Carolina. We are attempting to enter Florida. I'll actually be in Florida for a full week in a couple weeks, meeting with all the brokers out there because we want to enter Florida for the same reason, that we're actually going to have absorption increase significantly, meaning that demand is going to catch up to supply or outpace supply by end of 26 going into 27. Once that happens, you will see concessions or the specials start to burn off, which increases the revenue and the net operating income of these properties, which increases their value. And all these Sunbelt markets that have had negative organic rent growth the last 2 to 3 years, in the next 12, 24 months are going to have positive organic rent growth. So those headwinds the last few years, Buck, are going to transition to tailwinds. That's why we think now is the best time to buy, because rates are going to start getting cut, which drives values. Supply is going to be getting absorbed. We're actually going to have a shortage of housing the next 36 months across these major growth markets because nobody's been building the last few years. And so if we can buy these deals, and as you know, Buck, we're typically we're on a 5-year horizon, for these, and we're conservatively projecting to double investor money over 5 years. If we can do it sooner, we will. Then if we can buy now, we think the next 2 to 4 years, 2 to 5 years, we're going to have a lot of appreciation. And if you let's look at the stock market, Buck. I mean, it's at near all-time highs. I think everybody realizes that the S&P 500 is being propped up by AI companies, right? NVIDIA and these other companies. And it's like, that's great, but is there an AI bubble, kind of like in the .com era? You look at how much it's grown. You look at gold. I mean, gold has been hitting all-time highs the last 4 to 8 weeks, and that's kind of an indicator that investors are fleeing to hard assets because maybe they're worried about a bubble. Real estate, in our opinion, is the best hard asset you can invest in, right? Because you're getting cash flow, you're going to get that appreciation, you're going to get the tax benefits. We haven't even talked about the new Trump bill, which we can go into, but that's kind of where we're at, like macro-wise. We think now's a good time to be buying these apartment buildings.
You mentioned that you think that we're sort of at the bottom. What other indications are there that we're at the bottom that you can just sort of name? I mean, obviously you named a bunch of variables that make it a good time to buy, but why the bottom?
We haven't seen pricing or cap rates really change the last 12 to 18 months, right? So like 22, 23, as interest rates started going up, cap rates, there's a pretty direct correlation there, right? At a certain point, it's not going to be a 1-to-1 ratio, but as interest rates go up, cap rates go up. And for those of you who aren't familiar, cap rate, I tell people, is basically a fraction. It's like the net operating income. How much money is that property producing divided by the purchase price, divided by what price are you paying for it, right? So it's a measure of how good of a deal you're getting, so to speak. As interest rates go up, cap rates go up, which means that when cap rates go up, values go down. So when you're a buyer, you want to be buying higher cap rates. When you're a seller, you'd rather sell a lower cap rate. Well, we haven't seen cap rates or values really change the last 12 to 18 months. They've kind of just, bottomed out, so to speak. And so that's the biggest indication. We've been buying a lot of distressed deals the last 36 months. We've bought over a dozen deals where we have a seller who has a loan maturity coming up. And because interest rates skyrocketed, they cannot qualify to refinance the asset. And they have two options. One is you get foreclosed on by the lender and you lose all the money. And then you have all these legal ramifications, or you can sell the deal if it's worth that, sell it before the loan maturity to at least get enough proceeds to pay off the loan. And a lot of these deals we've been buying, Buck, we're buying them for the loan amount. So like they're wiping out all their investors, unfortunately, but we're getting massive discounts on them because they have no other option but to sell the deal. Now, we think with where interest rates are going to do, as interest rates start to cut, you will start to see cap rates also compress and go down, which will drive up values. And as cap rates compress and as interest rates compress, that makes your cost of debt cheaper, right? And so, with these properties, these are $20 to $100 million properties, that the space that we're playing in. And so every time the Fed starts to cut interest rates, your cost of debt gets cheaper. It's going to spur more transaction activity, more competition. And so, we just think that there's this window, the next 6 to 12 months, where we can still get in and buy. It's twofold. One is we need to get in and buy opportunities before all that competition does flood back into the market. Because the institutional space, it's very like it's a herd mentality and it moves slow, right? But once the big dogs start coming in, it'll all start flooding in, right? So we want to get in before the competition comes in. But we also, want to get in before the distressed opportunities are gone. right? Because
Yeah.
a lot of those deals are getting foreclosed or being sold.
You mentioned the big dogs coming back in, right? One of the issues in the market has been the sort of lack of liquidity. Not as many properties moving because sellers don't want to sell when it's not a good time to sell unless you have to. And then buyers, there's a lot of buyers, as you mentioned, are not participating in this market. So how does that dynamic change?
Yeah, it's funny, Buck. So like 2018 through 2021, it was the complete opposite of now. It was extremely competitive. There were a ton of deals available. There was a lot of deal flow, but it was very competitive, right? And so it's like to find deals that actually made sense, you really had to find off-market deals where there wasn't competition. Otherwise, it was getting bid up. Well, the dynamic has shifted now where, to your point, not a lot of groups are selling right now. We have not sold a deal, for example, at Rise 48 since July of 2022. We haven't sold a deal for 3.5 years, and we haven't even thought about it because it doesn't make any sense with where values are at. We're giving somebody a discount. So the only groups that are selling have to sell. They have no option. They've got some type of deadline looming, and they have to sell that deal. But there's very few of those, but there's also much fewer buyers. And so it's kind of funny. It's completely inverted from before, is that now when we get off market deals, most of them aren't real. They are sellers who are out there fishing to try to see what is their property worth. And then once they get feedback, they're like, oh, I'm not going to sell. It's way lower than I thought. Well, the marketed deals that are on the market, those are groups that they're under the gun. They're like, we got to get this thing sold and get it moved. And so I think that, one thing that has been consistent is that the groups who can actually execute are getting the upper hand. And so, right now there's a bunch of groups making offers, but they don't actually have equity lined up. They're just kind of fishing around. And so we're seeing these good opportunities where we're getting the first call. If it's a real seller that needs to sell because they're distressed, we can come in there and swoop that up. But they're really hard to find. I mean, since 2022, Buck, we have this data in our Excel model. We've underwritten over 1,000 deals now, nearly 1,100 deals, and about 28 of them have actually worked in our model. So it's literally a 2% hit rate. So it's like a needle in a haystack. We get a full team of analysts here at the office underwriting deals every single day. And so, it's tough to find the deals, but when we do find them, we feel like we're stealing them and buying them at a 30-40% discount.
Yeah, sure. And then on the flip side of, the sellers is the buyers. So, I had a guy on recently, was a professor of real estate, actually. And he was talking about sort of one of the other things that happens as as rates tick down, which is people who've got, huge amounts of money, institutions, whatever, in money markets and to start to look for yield. And so there is this idea that, that's going to be another part of, the real estate recovery and potentially a pretty rapid flip from being a market in which, we're in right now where it's, fantastic to buy, flip into a situation where it becomes a frothy market. That period of time could happen very, very quickly once that money starts coming into real estate. Is that kind of what you're hearing?
Yes, it's a great point you brought up, Buck. And there's two tiers to that, right? So when interest rates were low, okay, money market was like 1%, right? So it's extremely conservative. If you want to do money market or treasury bills, it's 1%, really low risk, low return. At that same time, in the first Trump administration, you had that 100% bonus depreciation, right? Which started to step down during the Biden administration. Well, when interest rates skyrocket, like they did, now you can get a 4 to 5% yield on money market for like virtually no risk. And so, if an investor is trying to compare, okay, I can get 4 to 5% cash on cash with this apartment building in year one, or I can get 4 to 5% money market, but the money market is liquid, then I'm going to go with the money market, right? And at the same time, as the depreciation has been stepping down, this second tier I'm talking about, if the depreciation benefits are not as significant as they were, then more of that capital is going to go to the money market, right? And treasury bills, things like that. Well, to your point, the guy that you just interviewed, as interest rates start to cut, the yield on the money market and T-bills is going to decline, pretty quickly. It's correlated to that. So now you're not going to get that 4 to 5% yield. It'll start inching back down to 3, 2, 1% as rates cut. Well, these apartment buildings are still producing 4 to 5% cash on cash in year one, right? And we're giving the investors a 7 to 8% preferred cash on cash, which they get caught up on, but they were getting that immediate 4 to 5%. And now with this big, beautiful bill that the Trump administration passed in July of this year, they've brought the bonus depreciation back to 100% bonus depreciation. So now we've just seen, just even the last 30, 60 days, really strong sentiment from investors because they can now get better yield, or they're going to get better yield in 26 by investing in apartments than in the money market or treasury bills. And you had that additional tax benefit of that depreciation getting restored to a much higher level. So yeah, that's going to basically incentivize all this extra competition to come into real estate, which will drive up those values.
Yeah, it's like, so the best investors, I think, sometimes look and say, where is the discount right now, right? And maybe at times that's gold, maybe at times that is the stock market, although it usually isn't, right? The discount right now is in real estate. Right now, the discount is in real estate. If you look at markets where you want to potentially, ride for the next 5 years, the goal here is you're not buying or investing in real estate for a year out. That's not what you're doing.
Right.
But if you look at where markets are right now and you say, where will these markets be in 5 years? If you look at the S&P 500, yeah, I'm sure it'll be up, but I don't, the issue is that you've got some corrections and we don't know how much, how big those corrections are. We just don't know. Right. Gold. I don't know. I wouldn't personally right now be buying gold when it's at all-time highs.
You're paying a premium, right? Yeah.
Or you're paying a premium. Right. Absolutely. And so it just, that's for me, that's one of the big signals here. Where is the discount? The discount is in real estate right now. And the discount is in real estate. And then beyond that, you've got all of these confluence of variables, descending rates, supply demand issues. And then, you've got tax benefits. You've got all these sort of winds that are behind you that are pushing you. And then on top of that, of course, you're not buying properties and just hoping. You're actually creating value on top of that, right?
Yep, exactly. Yeah, forcing the appreciation rather than relying on the organic appreciation, to your point.
Yeah. So, interesting. So let's talk a little bit, one of the things that, our investor group or investor club is looking at is a lot of times the things that we're seeing, you're pounding North Carolina or the Carolinas in general.
Yeah.
Right. Tell us about the North Carolina story or the Carolina story.
Yeah. So, I mean, it's a pretty simple thesis that we follow, Buck. I tell investors it's not rocket science. When the markets that we evaluate, the first thing we're looking for is we want to have very strong population growth. We want people moving to that market, okay, so that there is a need for housing. So we want really strong in-migration. I mean, there's much more people moving there than there are leaving there. North Carolina is top 5 in the entire country among states for new in-migration. And last week, I saw data from U-Haul, the moving company, Buck, and they just released their 2024 data. And it was kind of funny. And this sounds like very self-promotional. It benefits what we do. But the real data was they listed like their top 10 cities for most new moving into with U-Haul. And number 1 was Dallas, which we're in. Number 2 city in the country, Charlotte, North Carolina, for 2024, new in-migration of U-Hauls. And the number 3 was Phoenix. Okay, and those are the markets that we're in. And then as far as states go, North Carolina was the 3rd state behind Texas and Arizona. And so there are just a ton of people moving into North Carolina. So that's the first thing is population growth. We want people moving there. The second thing is job growth. We want companies that are strong, diversified companies moving into the markets that we're focused on so that there are good jobs, which are diversified across different sectors. right? So we don't really like, to be honest, not to pick on certain markets, but this is just our honest, subjective criteria. Like, we don't like Las Vegas because it's heavily concentrated in hospitality and tourism. We don't really like Houston because it's heavily concentrated in oil and gas. So like the jobs that are coming into North Carolina and Charlotte specifically, which is the biggest market in North Carolina, are very well diversified. I mean, I don't think you have any one sector making up more than, 15, 20%. And so, because these tenants, our clients are our tenants and residents. So we want them to go to work, make good money. They pay their rent. That rent goes to pay operating expenses, the mortgage at the property, and everything that's left goes through to our investors as cash flow, right? So we want strong population growth, strong job growth. North Carolina's top 5 for both of those in the country. So those are the 2 biggest things. It's in a very affordable market. So like the cost of housing, the rents have not, just escalated through the roof like a lot of these other big cities. And Buck, it's landlord friendly. Okay, which means that if somebody does not pay their rent, we can evict them in 30 to 45 days and get them out. Because at the end of the day, we are an investment company. We have fiduciary responsibility to our investors to be the steward of this asset. And so when I've got friends that have properties in Denver and in California right now, and they literally cannot evict people for 6 months who don't pay their rent. That destroys the property, destroys the investment. So that's always a very big factor. So, we've owned in North Carolina now for over 18 months, especially in Charlotte. And it's performing really well. Also, in Charlotte, it doesn't have nearly the supply of new housing as these other large markets. And we've been really focused on these micro submarkets, really focused on purchasing like in East and Southeast Charlotte, where there's not as much new supply. So you don't have to get hit with those concessions. And so it's a booming market. It's growing very quickly. We love North Carolina in general. We're focused on Charlotte, Greensboro, and then that Raleigh, Durham, Chapel Hill triangle area. But for us, it's a no-brainer. And we also look at data forward-looking. And you look at like the next 5 to 10 years, and U.S. Bureau of Labor Statistics is projecting, it's a top 5 market in the entire country the next 5 years for job growth. U.S. Census Bureau is projecting really strong population growth. And so we want to be in the markets that, we feel like we're getting in kind of early. You know what I mean? Like it's booming right now. It's already top 5, but it hasn't already peaked where all the pricing is really expensive and the cost of housing, things like that. And so we're really bullish on that market. I mean, there's not much. I think that in this current media environment we live in, there's just always a new headline, right? Like the sky is always falling. And I think if we look at the beginning of the year, the tariffs really have not had an impact. They haven't driven up inflation like people thought they would. At the time of this recording, Buck, you and I are recording this the week before Thanksgiving. And just yesterday, the government, it was shut down, for 45 days or whatever, a couple months nearly. They just released their September jobs data. Unemployment came in at 4.4%, which is the highest since October of 21.
How's that doing in Carolina, in the Carolinas?
In the Carolinas, we've been performing really strong. And so we've had strong occupancy, strong collections, low delinquency. So we haven't really seen, any impact. But I think the fact that unemployment number is ticking up, that's going to motivate the Fed to start cutting rates fast.
And, when it comes to the Fed too, like, honestly, the December cut probably should happen, but there's been signals that maybe they won't cut and stuff like that. But I think if you put into perspective, as you mentioned, Powell's out in May, I think. And I think Waller's probably going to be, Trump's guy Waller is probably going to be the new Fed chair.
Yeah.
And he is, they want to drive rates way down, Yep. And so, again, looking at this not as I'm investing in something right now for December, you know what I mean? You put the big, you get that big picture. And I think that's where you kind of have to think about it. So one of the things I like about, we had this conversation, Zach, about when we first met, and about potentially, getting exposure to, my investor group here, Wealth Formula. One of the things that I really liked about what you told me was want to be very practical, right? And flexible. And you want to take the wins when you have the wins.
Yeah.
Talk about that, because I think one of the things that happened to me personally is that with a company that I was working with is they didn't sell when they knew they should have probably sold, because I think they were planning something bigger. And I think that hurt them. Sometimes you got to take the chips off the table. What's your philosophy on that?
Yeah, no, 100%. I agree. I think that our philosophy has always been, we're a conservative group in general. Like, we've always taken low leverage loans. I tell people too, we're very boring. We're a very vanilla company. Like, we literally just stick to our box and we rinse and repeat the same type of properties and the same type of business plan, because we've built the entire company around that structure. So we try not to chase shiny objects. And part of that philosophy is structuring our debt so that we have flexibility, so that if the market cycle heats up and we're like, hey, we want to sell this deal early, or we want to refinance, we want to have the flexibility to do that. And I think a big difference that we saw, I told you at the beginning of the podcast here, Buck, that we just sold a deal in early 2022. It was like a 2x multiple for our investors. It was a home run. At the time, a lot of groups were not selling because they looked at the market was going to keep running up.
Yeah.
Right. And even like internally, my business partner was like, hey, maybe we should hold these deals. Like, it's going to keep going up. And, I was telling them, you know what, if we can hit that projected return, let's just pull the trigger and sell the deal. And like I said, the group that we just sold that to a few years ago, they just got foreclosed on a month ago. Right. And so I think that we pulled the trigger on a lot of sales at the end of 21. Like, we sold 5 deals in the first half of 22, Buck.
That could be great timing there.
Exactly. Yeah. That was the peak of the market in hindsight. And so we had 11 full cycle exits. And so for us, we don't want to quote unquote get greedy or try to pump it up too much. If we can hit that return, we'll sell and lock in that profit. And just kind of keep an eye on the overall market cycle. So yeah, we do like to exit early if we can. And because we also realize that that's just going to benefit your track record as well.
Yeah.
Like, if you're returning capital to investors and you're getting them a return, they're going to appreciate that and be grateful. We're in this for the long term. You know what I mean? And so we want to have a long, resilient and consistent track record over the decades.
Well, Zach, I want to thank you for being on the show. It's it's nice to get perspective on what's going out there from somebody who's pounding the pavement every day, and keep up the good work.
Yeah, thanks so much, Bob. Good seeing you. We'll talk to you soon.
Be right back.
You make a lot of money but are still worried about retirement. Maybe you didn't start earning until your 30s. Now you're trying to catch up. Meanwhile, you've got a mortgage, private school to pay for, and you feel like you're getting further and further behind. Now, good news, if you need to catch up on retirement, check out a program put out by some of the oldest and most prestigious life insurance companies in the world. It's called Wealth Accelerator, and it can help you amplify your returns quickly, protect your money from creditors, and provide financial protection to your family if something happens to you. The concepts here are used by some of the wealthiest families in the world, and there's no reason why they can't be used by you. Check it out for yourself by going to wealthformulabanking.com.
Welcome back to the show, everyone. Hope you enjoyed it. Just another reminder, if you want to take advantage, there's still opportunities within the Accredited Investor Club at wealthformula.com, Investor Club, to potentially take advantage of opportunities that will still close before the end of the year. What does that mean? Why does that matter? Well, if you're looking at potentially some serious tax mitigation, bonus depreciation is 100%. That makes a big difference if you're sitting on passive income that you can offset. So anyway, go to wealthformula.com, sign up for Investor Club, get onboarded, and let's talk. That's it for me this week on Wealth Formula Podcast. This is Buck Joffrey signing off. If you want to learn more, you can now get free access to our in-depth personal finance course featuring industry leaders like Tom Wheelwright and Ken McElroy. Visit wealthformularoadmap.com.